Hey guys, Eric here, Mr. Fired Up Wealth, and I'm excited today to bring you video number 1 in a series of 6 total videos that will cover 60 total stock picks for the next decade and that are going to cover the 11 different sectors of the stock market. Now, what I haven't told you yet is what kind of stocks I'm going to be covering out of those 60 stocks. And I'm excited to announce they're going to be dividend growth investing or DGI stocks, but not just any DGI stocks. They're what I like to call DGIF. What's that? Well, you've heard of TGIF. Thank God it's Friday. This is DGIF, dividend growth investing for FIRED. Now, I've got 5 criteria that I look for when I'm searching for stocks that fit into the FIRED portfolio. The first is it needs to have a 3% dividend or less in most cases. And the reason for that is you want the dividend to be low because you want the stock to increase in stock price and into share price. Number 2 is you want to have a dividend payout ratio of 50% or less. The lower, the better. Number 3, you want dividend growth for at least 5 consecutive years, meaning that the dividends that they pay annually, that number increases every year for at least 5 years, so they have that track record. Number 4, you want to look at that same 5-year growth in dividends, and you want to look at it and see the percentage. You want at least 10% growth in that 5-year period. Obviously, the higher the number, the better. And the last criteria, the 5th criteria that I look at is going to be the 10-year annualized growth rate of the stock. And you want that to average 10% per year or more. Again, the higher the number, the better. Now, I always say to focus on growth when you're young, and that's true. And these are still growth stocks, but they're dividend growth stocks that have growth. Not just growth on the dividend, but also the stock is going to grow in value. And that's what you really want to focus on, especially when you're young. So no matter who you are, if you're watching this video, you need some of that in your portfolio if you're a millennial or younger, even Gen X. I am Gen X, and I still have quite a bit of GGIF in my portfolio. I want it to grow, but the reason you want some of this in your portfolio is you need some protection when the market goes down. The stock market drops down. It's nice to have some yield so that you have dividends being reinvested and dripping, so you're buying shares at a cheaper price. But at the same time, you don't want to just buy, a stock that just sits there and doesn't do anything and just gives you a yield. You want the stock price to accumulate value as well. If you use those 5 criteria, you have a very good chance that stock is going to perform well, oftentimes even outperform the market, and it's going to build you wealth over time. Now, before we get started, one thing I want to talk about is today's video is going to be the top 10 financial sector for DGIF. I include fintech in financials. Typically, it would be included in information technology. I include fintech in financials. So you need to decide what's best for your own portfolio, but that's how I do it. So without further ado, let's get started. Okay, guys, let's kick it off with number 1. And this one's pretty obvious, but it's a great company. It's great DGI. It's great DGIF as well. And it's JP Chase, stock ticker JPM. So what are those 5 criteria that we were talking about for DGIF? I'm going to use a couple different websites today, and hopefully it'll help you. If you're not familiar with these websites, you can use them in your research. Hopefully this will help you find some new tools. So this is dividend.com, and you can go to dividend.com, and once you're in here, so I'm in JP Chase, you click on dividend, and hopefully this is big enough for you to see. Let me just zoom in. So the dividend yield is less than 3%, which is what we want, 2.65%. That's good. The dividend payout ratio, again, has to be less than 50%, and this is at 33.18%, which is very good. Dividend growth, we want at least 5 years. This one has 9 years, so that's perfect so far. What else are we looking for? So the other thing that we want to look at, and this is Fidelity's website. You can use a lot of different websites to get these statistics. I'm going to Fidelity's website. I'm going to dividends. I'm clicking more. And under this tab, it's going to give you a breakdown of the overview of dividends. This is the 5-year growth for dividends, and it's 17.61%. We want at least 10%. Obviously, the more the better, like I said. I want 20% or more usually, but 10% is a minimum. If it fits all the other parameters and it's a really attractive stock and it's at least 10%, you're good. Where it would be a red flag is if the growth wasn't at least 10% over a 5-year period. And that's where I would exclude it from from my list when I'm looking for DGIF stocks. So what's the last criteria? The last criteria is the total. We're looking at the 10-year annualized rate. The 10-year annualized. So the annualized rate is going to be how much the return on investment was for not only the stock price, but also the dividends included in that. And this website here, you can, I'll put a link down in the comments so you can see all these different websites. But this is a stock total return and dividend reinvestment drip calculator, which is really handy. I've already entered in the information. Actually, I'm going to change this. So today is the 31st of January. So we're going to go back to 2010 on the 31st January. And then we're going to put the same here. So we want 1 and then 31. So that if you see this starting date, 2010, January 31st, ending date, 2020, January 31st. That's going to give you a 10-year return. And the annual return is 15.84%. And we want at least 10%. The S&P 500 has historically been around a 10% return if you include the dividends. We want to outperform that when all possible. So 10% is the minimum. Obviously, we want more. And, this is at this rate, we're at 5.84% outperformance over a 10-year annualized rate. So it's very good. So why do I like the stock? We'll also dig into, let's just go to the overview. So it's a well-run company. It has a great CEO. The PE ratio is a 12.68, which obviously is good. Most bank stocks are lower, but it's still a very attractive PE ratio. It's performed very well over the last 52 weeks at 30%. Again, the 2.65% dividend. If you look at the earnings per share, they've beat 3 consecutive quarters by 32 cents, 23 cents, and 22 cents. It's just a great company all around, and it's great DGI. It's one that I have in my portfolio, and it's one you can look at for a financial stock that you can hold for 10 years. Okay, guys, moving along to number 2. And before I get to number 2, I do want to say that none of these stocks are in any order. They're not ranked in any particular order. There's 10 picks. Depending on your suitability, your age, your risk factors, all those different things, you can pick the stocks you like. So I'm going to give you 60 stock picks in this video series. Obviously, the intent's not to go buy 60 stocks. You're going to look at the video, maybe pick 1 or 2 that you think would be a good idea. You're going to research those on your own and then decide whether you want to buy them or not. So I'm giving you ideas. I'm giving you 60 stock ideas, and it's up to you to decide which fit best in your portfolio. So before I move along to Visa, I also want to say if you haven't subscribed, please do by clicking the little red button on the bottom right and click the little bell so that you get notifications, because you're going to want to see the rest of these videos. There's 5 more videos in the series after today. So moving along, Visa. So Visa is a rock star, and a lot of you probably own Visa. And I do want to say again and reiterate what I said in the beginning, that normally fintech is in technology, but I include it in financials. Okay. So you do whatever is best for your portfolio. I include fintech into my financials bucket, my financial sector. So Visa only has a 0.59% dividend yield, and it's low, but it has a 20.11% 5-year dividend growth rate, which is very good, and a whopping 26.79% 10-year annualized return. That's really good. Obviously they had earnings last night, and it's down 3.56% today, but the whole market is down with the whole coronavirus concerns. But this has been a rock star, and I see it being a rock star for a long time. The nice thing about the lower yield, it's one of those lower yielders that maybe in 10 or 20 years, though, if they keep growing it, 20% over a 5-year, it's going to take a little while, but you're going to eventually get over that 1%, maybe 2%. Maybe they'll even, as they become more of a mature company, they might even increase those dividends more. So these are the kind of stocks you want to be in early, like a Microsoft and a lot of different examples that we'll get to in other videos. One thing I want to talk about with Visa is they had a major acquisition, and the earnings, they did say that they're going to have maybe a little bit slower 2020. So it could be a buying opportunity if it continues to go down. And they just spent a lot of money on a company called Plaid. So let's talk about what Plaid is. And I'll go to the website so you can see. Here's Plaid's website, their products, their use cases, docs, pricing. So what is Plaid? So on January 13th of 2020, Visa announced it was paying more than $5.3 billion to acquire this company, Plaid. And I'll explain what Plaid is in a second, and I'll give you the layman's terms of what it does. This is the biggest acquisition Visa has made after it paid more than $14 billion for Visa Europe. That was back in 2015. In 2019, Visa actually made several good acquisitions as well, but let's focus on this one, Plaid. So what is Plaid? What do they do? You can kind of see through here APIs. If you're familiar with what APIs are, you kind of have an idea of what it is. But you can see down here, who do we work with? Venmo, Betterment, Coinbase, American Express, Acorns, Fannie Mae. This is huge. So what is Plaid and what do they do? Plaid has developed a plumbing system or rails to enable a payment app like Venmo and all the ones you see here, Betterment, Coinbase. So it allows a payment app like a Venmo to be connected to a bank. It used to be where the process to connect to your checking account took a few days. Remember back when you had to deposit 1 cent to verify that it was connected? Well, not with Plaid. You are connected to your account instantly. Why does Visa care about this? Because one day people are not going to take out a piece of plastic, a credit card, and swipe to make a purchase. They're going to use an app, probably on their phone. And Visa wants to be where the customers are going to be. Visa, it's everywhere you want to be. They want the process to be seamless and instant. Visa, like I just said, it's everywhere you want to be, and they're preparing for the future. This is a great thing. If you're a Visa shareholder, this is great. And I think that this stock is going to continue to perform. It might not perform 27% in 2020. Maybe it will. But it's one, if you buy it and hold it and continue to add to it and let the dividends drip, I think this is going to be a great one in your portfolio. All right, guys. So moving along to number 3, and I'm going to mix it up a little bit. I'm going to give you a stock that you probably have never heard of, something that's a little bit off the radar for probably most people. So I'm using the Fidelity screener. There's a lot of screeners out there. You can use FinViz. There's a bunch of them. Just Google screener. But if you're a Fidelity customer, if you're in it with any major brokerage like TD Ameritrade, they all have screeners. This is the Fidelity screener, and I've gone in and already entered the information. So dividend payout ratio, we're going to, they have medium and low, so it's 54% and basically under on the criteria. I typed in everything we need. So I've got the dividend yield at 3% or less. I've got the dividend growth rate. I've got the 10-year return. So you can see everything in here. So what I like to do, I like to go and just click and see what's bullish right now. So I click this button here, and I'm gonna zoom in on this because I know it's kind of hard to see. So I'm gonna zoom in, and then I'm gonna scroll over so you can kind of see. So we're looking at all these different stocks. So these are all very bullish right now based on this ESS score. Here's the total annual return. You can actually, you could search that way. The dividend growth rate over 5 years, the dividend yield, and then this is the payout ratio, the LQ, right? So the one I want to focus on out of this group that I picked next to talk about for number 3 is this WSBF, and it is a micro cap, 481 million. So this is kind of cool because if you're looking for financials and say you want to mix it up, not have all mega caps. A micro cap's kind of a cool thing. There's more risk in those, of course. They're not as established, but they also sometimes have a lot greater reward, just like anything, risk and reward. But if you look at this, I mean, heck, the payout ratio is only 28.52%. The dividend yield is pretty solid. It's still under 3. It's at 2.7%. That's a great, ratio there. And then they have a 19.14% 5-year dividend growth rate. And heck, the 27% on the 10-year annual return. That's really solid. So let's take a look at this. Let's dig into this. Again, I'm on Fidelity. This is Waterstone Financial Inc. $470 million micro cap, 479.16 million. Stock ticker WSBF. I'll zoom in again here for those of you on the phone. And 12.8 PE ratio, which is actually pretty close to JP Morgan's, if you remember. Similar yield as well at 2.72%. It's only up 9.57% in the 52 weeks. So there could be some opportunity there because maybe it's lagged. You can see the chart kind of nosedive and you think, well, what's going on there? So obviously there's probably some earnings issue. you can see that the valuation, according to this, they're saying it's overvalued. Doesn't always mean anything. And it doesn't actually have the earnings per share like the other ones normally do. Let me refresh this and see if I can get that to load. Maybe it just doesn't have enough information. That's possible too. But here's the chart. Let's see if this loads. Try to zoom back out. Nope, doesn't have enough information. So you can see though, this is one that has kind of dove down. It looks like they had some quarterly results and it sold off. Now it's a little bit less expensive. The 52-week range, it ranges between 1555 and 1948. Take a look at this one. It's just an idea, guys. It has some pretty good historical information. Let's look at the 10-year chart. Actually, I like to look at these. So this is usually a tell sign for me. Obviously, this is 2011. So you've got the financial crisis back in 2008. All the banks got hammered, and you can see it kind of went flat, dipped down a little bit, and then it's a pretty nice chart and solid growth, kind of hitting a little bit of a wall here and a dip. So maybe it keeps going down and maybe it rebounds back up. Do a little bit more homework on it. It looks like if you click into here, it talks about Waterstone Financial reports net income of 34 cents per diluted share. This is a Wisconsin-based company, so I was going to actually look at that real quick too. So this is interesting. It's a very niche type company. It's Waterstone Financial Inc. operates a bank holding company, provides various financial services and customers in southeastern Wisconsin in the United States. Operates two segments, community banking and mortgage banking. I mean, that's a pretty specific niche, to be Wisconsin and then specifically southeastern Wisconsin. But to be doing $479 million, I don't know. That's pretty decent. So sometimes these little gems are just excellent in your portfolio. This is the kind of stuff Warren Buffett is just really good at. He'll find these banks that you've never heard of, but they just crush it. And that's how screeners can be useful, because I guarantee you're not going to see Waterstone Financial on the news or on CNBC. The only way you probably know who they are is if you live in Wisconsin or, if you've visited that area. But if you live anywhere outside of there, you probably have no idea what this is. I certainly didn't myself, but looking at the numbers, it looks like something interesting that you can explore a little bit further. Okay, guys, so let's move along to number 4. And I don't know about you, but that was fun for me. So let's use the same exact screener that we just did. And there's a bunch of them in here. So let's take a look at another one. And this is one I've dug into a little bit already, Rowe Price. And you can look, this is a 34.5% dividend payout ratio, a 2.23% yield, which is a little bit lower, but still good. 11.55% dividend growth over 5 years, which is on the low side, but still above the 10%. And then the total annual return, the 10-year total annual return of a 13.79%. Obviously, it's down today as well, along with everything else. So let's dig into this. Let's click on Rowe and dig in a little bit further. I will zoom in so you can see it on your phones. So you can see here, it's a 2.23% dividend yield. It's a 15.6 PE ratio, so a little bit higher, but that's also because it's a different category now. We're looking at financials, large cap, and this isn't a bank. Of course, Rowe Price is going to be a brokerage. This is up 53.04%, 52-week high, which is really good. The PEG ratio is a 1.72 on the 5-year, and looking at this, here's the earnings per share. It beat the last 3 quarters at 12 cents, 15 cents, and 8 cents. It looks like the valuation may be undervalued, and it's very high quality based on this fundamental analysis. Again, these aren't always right, so do your own homework. But it's good to get a quick snapshot just when you glance at a stock to see, what Fidelity's thinking on with their core software. So. But the analyst actions, Wells Fargo lifts Rowe Price Group price target to 152 from 146. Again, that doesn't mean anything either, but they're overweight. It looks to me like it's pretty bullish. It's got a nice chart. I'm looking at the 1 year. I'm going to click on 10-year and see what that looks like. And let's see. There's a 10-year chart. Same kind of deal. Once 2011 kind of cleared up, 2012, it's kind of sat flat for a while and had an uptrend. Here's a nice nosedive here. It looks like in 2019, and it's been uptrending. So this isn't the prettiest of all charts that I've ever seen, but it does fit in the parameters. It's something I thought was interesting with a decent yield, and something that, you could definitely research more. Could be a decent pick for a DGIF portfolio selection. So take a look at Rowe Price, stock ticker TROW. All right, guys. So moving to number 5, and you probably knew this one was going to be on here, but Bank of America, stock ticker BAC. You're going to have a low PE ratio, fairly low. It's a normal, for banks, it's always generally in this range. 2.15% dividend yield. The price performance is a 15.17 on the 52-week. Now, if you look at the 10-year annualized return on this, it's actually just below 10%. So it hasn't been as good of a performer. I think a lot of that has to do, if you look at this most recent dive, it didn't help at all, but it has been really up and down. So if you look at the 10-year chart on this, it's going to take a second to load, but the 10-year chart, you can see, it's done the same thing from 2012, kind of ramped up, but it kind of sat here. So this was around the election time, Trump election, and then a lot of deregulation, and you saw the price kind of go up, and then you had the trade war and interest rates, all that. So it kind of sat here. If you look from 2018 to basically now, it started to come up, but now it's dipping back towards that $30 mean. I own quite a bit of this actually in my portfolio. I bought it around here in 2016. So, I got it for a pretty good price, and I think it was $13 is my cost basis, and it's trading at 32. So it's been pretty good for me. But I just wanted to kind of read this to you. So Bank of America's dividend yield of a little over 2% is lower than several of its peers. However, the company is in better position than most to double its dividend over the next few years, given a payout ratio of only 23%. Additionally, many analysts predict Bank of America will be able to increase its earnings by more than 7% annually on average over the next 5 years. That's admittedly a lot lower than what the company has achieved in recent years, but that has a heady time for most of the financial sector. And there's certainly a question about how interest rate fluctuations could affect Bank of America's earnings. Falling interest rates took a toll on earnings in the company's latest quarter. Still, Bank of America appears to be in a solid position for future earnings growth. Bank of America's dividend has shot up 140% in just the last 3 years. The financial crisis that led to the Great Recession caused the company to slash its dividends in 2009 after going a few years without dividend increases, though Bank of America appears to be back on course to deliver solid dividend hikes year in and year out. So I actually want to go to dividend.com and I want to look at Bank of America and see. So it's 6 years. So dividend growth is 6 years. We want 5 or more. Dividend payout ratio, 23%. Pays 72 cents annually for the dividend, and it's 2.15. So this one fits in the category. I like it based on what I just read to you. I do think it's one that will have solid dividend returns. I think you'll see that 2.15% yield grow pretty quickly. Take a look at Bank of America, stock ticker BAC. All right, guys, so number 6, let's do another bank, and this time let's do one that actually is a little bit higher yield. It actually is over the 3%, which is normally a criteria for DGIF. But in case there's some high yielders, people looking for higher yield, I actually think that KeyCorp fits the mold for DGIF, even though the yield is actually above 3%. And there are some cases like that. So let's take a look at this one and see why. So 11.85 on the PE ratio. I'm not going to spend a lot of time on this page because we've done that on a couple other ones, but I'm going to look at the 10-year chart here and let's see what that's done. Again, 2012, you saw a little bit of a dip here and then it's kind of working its way back up. So this is going to have a very similar chart pattern to most of the banks. Let's look though at dividend.com. So 9 years of dividend growth, a 39% payout ratio. So we're still well below the 50% and a 3.88% yield. I did a calculator for the total market return, and this one actually on the 10-year annualized, so looking from 10 years, you're looking at a 12.7%. So it's outperforming the S&P by 2-3%. Not blowing the doors off, but it's one of those, 3.8% yield is a great kind of safety stock situation, especially with the, rates so low. If the rates start going up, stocks like this can start to outperform in your portfolio. So it's good to have that diversification. And that's why we're doing this. So let's look. This is from so KeyCorp fourth quarter 2019 earnings review. This happened just a week ago. And I just wanted to look at a couple things. And if you're not doing this, you should be. So just because you see something on YouTube or whatever, you need to do your own homework. You need to go to the websites, go to investor relations and look at financial reports, understand how to read them. Make sure you're doing your due diligence, guys. So you can see here's the Q4 2019 earnings per share, 45 cents. I'm not going to bore you to death, but you can see some of the numbers on your screen, and I encourage you to go check it out on their website for yourself. Average loans are up 5% from a year ago, Q4 2018. And then from the prior quarter, their average loans are up 2%. So if you know anything about banks, these metrics are important. You've got the 7% year over year in the C&I, and then the 12% year over year in the consumer. Deposits, you can kind of see the chart pattern here. I like looking at these deposit mixes to see, what are CDs, what are savings, the non-interest bearing. These are all important metrics if you're looking at bank stocks, and it comes with lots of practice, lots of time looking at these. But it's important to at least, even if you don't understand all of it, you'll learn, right? So just take a look at some of these and do your best to understand them and to learn. Here's the loan portfolio detail as of the end of 2019, and commercial and industrial is 48.3. This is in billions. Commercial real estate is 15. Lease financing. You can see the diversified portfolio by industry. I'm going to zoom in on this and see. And it's not letting me zoom in on that one. But let's see, view, zoom. I can't zoom in any further. Sorry, guys. Diversified portfolio by industry, though, you can see all the breakdown. I think this is really helpful. Here's real estate, public sector. Real estate's a big chunk of it, but you've got chemicals, construction, consumer services. Very diversified commercial loan portfolio, which I really like. And here's some more kind of information. So here's the dividend yield history and payout. And like I said, it pays almost a 3.9% dividend yield. The PE is attractive where it's at, kind of in line with most banks. The technicals really aren't excellent here, so it could go lower. It was down, obviously, 1.94%. This could be a buying opportunity, especially if it goes any lower. I actually like this stock under $20. Take a look at it. KeyCorp, stock ticker KEY. Number 7, guys. You knew it was coming. MasterCard. Not going to spend a lot of time on it. It has more growth potential than Visa at this point. It's a huge company. It's expensive. It's a 41 P ratio. It only pays a 0.49% dividend yield, but it also has been up 59% on the 52-week. And this is why I like having fintech in my financials, because financials a lot of times aren't always performing the way you want them to, especially when interest rates are low. And it's great to have these kind of thrown in there. And these are true DGI plays. I mean, if you look at let's just pull up MasterCard. This again is dividend.com. You go under MasterCard. This has 8 years dividend growth, super low payout ratio of only 17.67% and a 0.49% dividend yield. It has on the dividend had consistent growth. I'll go ahead and take a look at the 5-year growth on this one. So this one is 20.11% on the 5-year growth. So, very similar to Visa, where it's a solid company. They're not going anywhere. Honestly, a lot of people will tell you they like MasterCard better than Visa. And I think I agreed with that until Plaid. The Plaid acquisition, to me, I think puts Visa ahead of MasterCard, but you can't go wrong with either, guys. So, don't yell at me for saying that I like Visa better than MasterCard at this point. You can pick both of them. And if you're not sure, just buy a little of both, I think, and hold them in your portfolio for a long-term hold. Okay, guys, next for number 8, I'm actually going to give you a 3-for-1. So this is actually 3 stocks for number 8. And the reason is that there's 3 companies that are really close. They're almost all the same. And depending on your geographic location, you might prefer one name over the other. And what it is it's financials insurance, but it's really about title. So real estate title insurance. And there's three companies. There's this STC, which is Stewart Information Services. So Stewart Title. There's FNF, which is Fidelity National Financial Inc. It's not Fidelity like the brokerage. It's Fidelity National Financial Inc., FNF. And it's financials, it's insurance, but it's really about mortgage title insurance. And then the other one is FAF, which is First American Financial Corp. Now, all three of those are really solid, and I'm going to scroll over and show you some numbers here. So in Stewart, the dividend payout ratio is 10. On FNF, it's actually 34, so it's quite a bit higher, and FAF is 25. For Stewart, the dividend is 2.86%. That's STC, the ticker. FNF is a 2.69. So again, they're so close. And then FAF is a 2.8%. So all three of it, 2.86, 2.69 and 2.8, almost all the same. 5-year dividend growth, or 5-year dividend growth rate. Stewart actually has a 64%. FNF is only 11.67%. And then FAF is very close with a 12.89%. Now, this one hasn't been around for 10 years, so it doesn't have the total 10-year annualized return. But FNF is a 23%, and Stewart is a 17%. So I look at this, me personally, I look at this and I say, well, they've had great dividend growth at Stewart, STC, 64%, which is good. But FNF has averaged a 23% 10-year annualized return. And they probably have more room to grow this 11.67 is my hunch. And the dividend's actually still about the same. The payout is a little bit more though, so I guess you could argue either way. But you could dig into any of those. I personally own FNF, and I bought this a while ago. Just something I found and it looked interesting. I bought it down here at 40. I think I bought it under 45, and it's at 48. So I'm up, I don't know, 6-7% or something before today, down a little bit with the rest of the market. But it's got a, like we said earlier, 2.68. The PE ratio is a 17.83. It's up 38% for the 52-week. Now, obviously, there's some risk with all three of these, and that's why it's one pick. There's three different companies. You can choose one, and the reason for it is because they all kind of do the same thing, and there's a lot of risk there. You can see this chart is actually a pretty nice looking chart. But the problem is it's reliant on, real estate. So if we have a housing crash, these are the first ones that are going to get hit. So, when people stop buying houses and the market slows down the economy, here's what's going to happen. This stock started in 2006 and it crashed hard during the financial crisis and then bounced way back up. I want to read just so you understand what this is. So Fidelity National Financial Inc., together with its subsidiaries, provides various insurance products in the United States. The company operates in title and corporate and other segments. It offers title insurance, escrow, and title-related services, including trust activities, trustee sales, recordings. So it really comes down to, real estate, transaction, title, but they do other things as well. But that's really what it comes down to. So if the housing market's doing well, these guys are going to do well. It's one that you can get in, but you might not necessarily be holding these for 10 years. If the housing market starts to correct, you could hold it through that and continue to add and wait for the rebound on the other side, or it's something that you might actually want to sell if the economy goes poor. But take a look at all three of those. It's FNF, which is the Fidelity National Financial. There's the Stewart Title, which is STC. And then there's the FAF, which is the First American Financial Corporation. All right, guys, hang in there. We got two left, and these are both really good picks, and I want you to take a look at both of them. Number 9, we're going to go ahead and look at Allstate. This is right here, stock ticker. Well, that didn't work. Stock ticker ALL, Allstate, the Allstate Corporation. I actually went to a 49ers game, and that Allstate dude, the guy that does the voice, you're in good hands, whatever. He was sitting right in front of me, and I actually got to meet him, just shook his hand, and he's probably annoyed, like, leave me alone, whatever, dude. So it's a large cap. So obviously insurance, right? So property, property and casualty insurance, and it's a $38.47 billion large cap. This is a 22% dividend payout ratio, a lower dividend, which is it's a nice dividend, 1.69%. Dividend growth over 5 years is about 12.3%. And then the annual is 17, which is really good. So you're looking at, some decent performance there. 17.23% average on the 10-year annualized return. Very, very good. And you're even going to like the chart better. I think this is a very nice looking chart. 15 PE ratio, obviously, that's not terrible. Insurance is still going to be a little bit lower than, it's not a growth stock or anything like that. Let's go to the max chart. And, earnings per share, 2 cents beat, 64-cent beat. That's impressive in Q2 2019, and then a 20-cent beat. So they're performing. Looks like they're firing on all cylinders. According to the Fidelity fundamental analysis, valuation seems undervalued. Middle of the pack on the growth stability. Quality is good. Financial health is good. Always like that. And here's the chart. Check this thing out. So 1994. It shot up. 2000. Here's the tech bubble. Crashed. Climbed up a little bit. Crashed down below the 2000 price. So if you bought, you bought this in 1994, you're sitting here in 2009 going, oh my goodness, like this has been a terrible return on investment. There's a lot of stocks, unfortunately, that fit that criteria. And then it, bounced up 2012, kind of nosedive again. But look at it, just a straight shot. I mean, this is a nice looking chart from 2012 on. The question is will they keep going at this pace? It doesn't seem like it's overpriced, here. It really just, it doesn't. I think they've grown a lot. They've done a great job with their marketing. Insurance is a huge industry. My wife works in that field, and there's a lot of insurance companies. There's a lot of competition, but there's some big companies like Allstate that just, keep finding ways to get that business, and they kind of dominate the market. So take a look at Allstate, stock ticker ALL. Okay, guys, last pick, number 10. And I really appreciate you staying with me this long. I know it's a long video, but I don't want to just make a 5-minute video saying, here's 10 stocks. I want to give you some actual information behind why I like a stock and hopefully help you do some of the homework. Obviously, I want you to do your own due diligence, make your own decisions. Don't buy something just because I'm giving you some information about it. I'm giving you some ideas, and hopefully you'll take those ideas, you'll research on your own and decide if they're a good fit for your portfolio. But I really appreciate all the support. A lot of you guys I know are watching this video well into 30 minutes, and I can't thank you enough. It means a lot to me. I can see within the Google Analytics, the YouTube Analytics, I can see how long people are watching. And of course, not everybody's watching as long as you are. But for those that are watching this long, thank you very much, because you mean the world to me. The support is it's been tremendous. And I can't thank you enough. I appreciate you very much. I'm passionate about this, and hopefully it's helping you, and it's a win-win for everybody. So if you haven't stopped by the website, this is firedupwealth.com. If you go to firedupwealth.com, it's going to direct you to firedupwealth.weebly.com, just because I'm hosting it through a free site for Weebly. Weebly is actually owned by Square, which is a great finance pick if you're looking for something that's not DGIF. But and I do own a lot of Square. But anyway, I digress. But take a look at the website, and let's just get right into number 10. And I wanted to do something that was maybe a little bit, kind of off the wall that you've never heard of before. This one's Ameri-Safe Inc., and it's a small cap. It's a $1.32 billion. And I kind of want to read about this stock of the company, the profile, just real quick. Hang with me. Ameri-Safe is an insurance holding company, underwrites workers' compensation insurance in the United States. Its workers' comp insurance policies provide benefits to injured employees. You don't need to read the rest. The company, oil and gas, it works oil and gas, construction, trucking, blah, blah, blah. So what does it say? Oh, it's based in Louisiana. Cool. It was incorporated in 1985 and based in Louisiana. And obviously you can go to the website and look more, but workman's, it makes sense. The unemployment rate is historically low, and so more people working equals more workman's comp insurance, right? So this is done really well. Here's a chart again from the 2008 financial crisis. Great Recession, whatever you want to call it, and it's just a straight line up. This is actually one of the best charts out of the top 10. It pays a 1.46% dividend yield. It's a 16.97 P ratio. So the P ratio is a little bit higher, but it's performed well. You can see it's kind of sat flat here for a little while. So there's a good chance, it seems like it's acting pretty bullish, that this might actually start going up from here. It was $72. It's down to 68. And what's cool about this is it was green on a red day. We were down 2% today market wide, and this thing just sat here, and that's why I like having some of these safer stocks, because, this one makes sense with the economy, right? I mean, if people are working, then there's gonna be workman's comp, and that's why the stock didn't nosedive with everything else today. And you can see earnings per share beat 11 cents, beat 10 cents, and beat 29 cents. All this fundamental analysis looks pretty strong. The midterm sentiment from 6 to 9 weeks is kind of weak, which isn't really that surprising. And let's take a look. That's actually kind of old. So, but yeah, you can look, here's some ETF in every stock too. If you like ETFs, you can look at, there's, different screeners that will show you this, but this shows you top ETFs by exposure. So this OSCV small cap has 1.26% exposure to this stock, Ameri-Safe, AMSF. I won't spend much more time on that because I know this video has been long, but I do want to point out a couple of other things before we wrap up. So first of all, I've got 5 more videos coming, and I need you to subscribe. If you haven't subscribed, please click the little red button on the bottom right-hand corner. There's also a little bell you need to click so you get notifications. So please do click on that bell to get notifications. And what else? So this is called the top 10 for 10 years that you can hold for a decade. And again, I've said it throughout the video, but I want you to do your own homework. So I want you to research these stocks. Don't just go buy them because they're on the video. They're just ideas. And when I say, top 10, these are top 10 ideas. There's a ton of other stocks that could have been on this list. And I'll just throw out a couple bonus picks. So DFS, that's Discover Financial Services. I own some of that. That's obviously they do credit cards and loans. That's a decent DGI play. American Express is another one. So both of those are going to be in that, fintech, financial services area. Discover is kind of interesting because it's a little bit of a hybrid, between credit cards and banking. They've got a lot of loans and things. And then another one is Ally Financial, ALLY. That's another one that I own some of. You can take a look at, but there's a ton of different stocks. I wanted to try to give you some, obviously a few obvious ones like the JP Morgans and the Visas, but then I wanted to provide some other stocks that fit in within the DGIF criteria that maybe you've never heard of. So I hope this video was, helpful and was, something that gave you some creative ideas so that you can look at your portfolio. The reason that this is so important is you look at your portfolio, you might be underweight in a certain area, and it's important to be diversified because the market's constantly changing. And the way Wall Street works is it's called the Wall Street Fashion Show. So what's in fashion and what's popular today is not popular tomorrow. And you'll see it. I've been doing this for over 20 years. That money will rotate. It rotates from one sector to another. And that's why it's important to always be, diversified. And you can choose your own percentages of how you do it, but have a little bit of variety. Don't just go buy 100% tech stocks because I guarantee you're going to have some very painful days. But again, I hope that you enjoyed this video. I'm going to be doing 5 more, so do subscribe. If you haven't stopped by the Fired Up Facebook group, I also encourage that. We do a lot of conversations in there, some dialogue. It's a really fun group. We have over 1,000 people in that Facebook group, and it's very interactive, a lot of Q&A. So go to Facebook, search Fired Up Wealth, and you'll find it. Make sure you fill out the answers completely, because anybody that doesn't fill out the answers completely, they get automatically rejected. And the last thing I want to say is that obviously I'm not a financial advisor. I simply provide information that hopefully is helpful in your research, and I give you some opinions of things that I believe in. But I'm not here to pump a specific stock. I'm certainly not your financial advisor. I'm not your attorney. So I appreciate you very much. I appreciate you watching this video. Have a great rest of your day. Take care.